Welcome to Iron Financial, the place where we forge stronger portfolios by putting market stories under some serious pressure. Today, we're tearing down the earnings report for Williams-Sonoma. Now, on the surface, the numbers look like solid steel. Truly impressive stuff. But in a market like this, you have to look deeper. You have to search for those hairline fractures. So that's what we're going to do. We're going to dissect this report piece by piece and figure out if Williams-Sonoma has really built a fortress that can stand the test of time, or if it's just a house of cards, waiting for the next gust of wind to knock the whole thing over.
And really, that's the billion-dollar question, isn't it? Especially for anyone thinking about putting their hard-earned capital to work here. Look, they've had an incredible run. Nobody can deny that. But we all know the old saying, past performance is no guarantee of future results. And that's never been more true with the kind of economic headwinds we're seeing right now. So is this fortress built on solid bedrock, with the deep, competitive moat? Or is the foundation starting to show some serious signs of stress? Is this a genuine opportunity to buy a best-in-class company? Or is it a classic value trap dressed up in premium branding? That is what we're here to find out.
All right, let's get right into it. We're going to start with the bull case. And I have to tell you, when you just look at the headline numbers, the argument is incredibly powerful. Williams-Sonoma appears to have built an absolutely undeniable fortress of profitability. And we're not talking about just squeaking by here. We're talking about market-dominating performance, especially in what's been a really tough retail environment. The numbers themselves, they tell a story of incredible operational strength.
So let's start with the big one, the anchor point for this entire argument, $8.84. That's the diluted earnings per share for the full fiscal year. Let me be perfectly clear about this. This isn't just a good number, it is a record number for the company. Think about that for a second. In a year where so many other retailers were getting hammered by inflation, crippled by supply chain chaos, and dealing with a super nervous consumer, WSM wasn't just treading water. They were posting the best bottom-line results in their entire history. This is the first and maybe the most important pillar in the whole bull case. It screams that management is executing at the highest possible level.
Okay, record earnings are great, but you have to ask the tough question. Where did they come from? Is it just from aggressive cost cutting, or are they actually growing the business? And this slide, well, it adds some really important color to that question. We're looking at a 3.5% full-year comparable brand revenue growth. For those of you who don't live and breathe this stuff, comps are the absolute lifeblood of retail. This metric tells you if the core business, the existing stores and websites, are healthy. And a positive 3.5%, that's a strong signal. It means year over year, they're selling more stuff. It suggests they aren't just holding their own, they are actively stealing market share from weaker competitors who are probably struggling just to keep the lights on.
And this chart right here is fantastic because it shows you exactly how they're getting it done. You have to drill down past that big consolidated number. Take a look at the performance of the individual brands, especially in the all-important fourth quarter. The flagship Williams-Sonoma brand, absolutely on fire, up over 7%. That is a massive number in this environment. West Elm, their more modern, trendy brand, is up almost 5%, and Pottery Barn Kids and Teen is holding its own, up a strong 4%. So you see, this isn't a story of just one hero brand dragging the whole company along. This is broad-based, solid strength across their entire core portfolio, which is precisely what you want to see as an investor. It proves their multi-brand strategy is a real structural advantage, not some kind of liability.
Now this is where it gets really interesting, because this slide isn't just about the number, it's about what that number signals. A 15% hike in the quarterly dividend, let me tell you, companies do not do this lightly. A dividend is a promise, a commitment to shareholders. And a significant increase like this is basically management pounding the table and shouting, not only were our recent results fantastic, but we are fundamentally confident in our ability to generate cash and profits for the foreseeable future. They're putting their money where their mouth is, plain and simple. They're committing to returning a bigger piece of that record profit directly to investors. That is a powerful, powerful statement about their belief in the durability of this business.
And there you have it, straight from the top, from CEO Laura Alber. She's framing the narrative for the bulls perfectly. Listen to those words: sustainable, profitable growth in a dynamic environment. They're not pretending it was easy, they're acknowledging the tough backdrop, but they're hammering home their outperformance. She sees their brands, their products, and their team as a competitive moat that lets them thrive even when everyone else is struggling. So let's sum up the bull case. You've got record earnings, solid top-line growth, strength across all the key brands, and a management team so confident they're jacking up the dividend by 15%. It really does look like a fortress.
A fortress. Okay, I get it. It's a strong narrative, a compelling story, and the market clearly bought into it, at least at first. But here at Iron Financial, we don't just stand back and admire the architecture. No, we send in the engineers to stress test the foundation.
Because any structure, I don't care how impressive it looks from the outside, can have hidden weaknesses, hidden flaws. So now let's put on our hard hats and start looking for the cracks. Because when you dig just one layer deeper into this report, that perfect, pristine picture starts to get a little bit blurry.
And here we go, crack number 1. For all the rosy talk about a strong finish to the year, they actually missed on the top line in the fourth quarter. The Street, all the analysts, they were looking for $2.41 billion in revenue. What did they deliver? $2.36 billion. Now you might think, that's not a big deal, but context here is everything. The fourth quarter includes the holiday season. It is the absolute Super Bowl for retailers. A miss here, even if it seems slight, raises some serious questions. Did consumer demand start to soften right at the end of the year? Did their pricing power slip a little bit? It shows that even with all their brand strength, they are not completely immune to what's happening in the broader market. The armor has a dent in it.
Now, let's talk about profitability, because this is where things get really revealing. The lead analyst pointed out the record full-year EPS, which is fair, but let's look at the plumbing of the most recent and most important quarter. Q4 gross margin, that's the profit on the goods they sell, it fell by 40 basis points. But you have to look at the driver. This big purple slice of the chart tells the real story, a 170 basis point hit from lower merchandise margins. Let that sink in. That is a massive drop. It means the markup on the products they sold was significantly lower than it was the year before. This completely contradicts the narrative of full-price selling. This number screams one thing: promotions. It suggests they had to slash prices to move product, and that directly attacks the quality of their earnings.
And the pressure isn't just on the gross margin, not by a long shot. This table lays it out in black and white. Look at the operating margin, which factors in all the costs of actually running the business. It took an even bigger hit, dropping a painful 120 basis points down to 20.3%. And what was the key driver here? Higher general expenses. So let's connect the dots. Not only are they making less money on each product they sell, but their overhead costs are also rising as a percentage of their sales. This is a textbook margin squeeze. And when your profitability is getting squeezed from both the top line, the gross margin, and from the middle, your operating costs, that's a very serious red flag about the underlying health and efficiency of the business. The fortress walls, they're definitely getting thinner.
Okay, a nearly 10% jump in inventory, I agree, that's the number that's going to make you sit up and take notice. Now, management does say that about $80 million of this is because of tariff-related costs that got baked into the value of the inventory on their books. So that provides some cover, but you're right, it doesn't explain the whole increase.
Exactly. And that's a huge risk. Inventory is just cash sitting on a warehouse shelf, not earning you anything. A 9.8% increase, bringing the total to $1.5 billion. That is a substantial pile of stuff. This raises a critical question for any investor. Is this inventory a smart bet on future growth? Or is it a sign that they badly overestimated demand and now they're stuck with way too much product? Because if it's the second one, there's only one way to clear that inventory: heavy, deep discounting. And that would put even more pressure on those merchandise margins we were just talking about. This could be a leading indicator of some real pain coming down the pike.
And let's be real for a minute. The company isn't operating in some kind of perfect bubble. The very foundation of their business is tied to the home, and the housing market has been persistently weak. Fewer people moving means fewer people buying new sofas and dining room tables. It's that simple. At the same time, the entire retail landscape is just brutally promotional right now. Competitors are slashing prices left and right, and that creates a gravitational pull on everyone in the space. Now, you add in rising operational costs and the direct, acknowledged financial hit from tariffs, and what you have is a perfect storm brewing. The bull case hinges on Williams-Sonoma being strong enough to defy these powerful forces. The bear case says that no fortress, no matter how well built, can withstand a Category 5 hurricane forever.
I agree. The headwinds are very real, and that margin pressure is a completely valid concern. The skeptic has laid out a compelling and frankly necessary case for caution. But this is where the analysis has to get deeper. See, a truly great company isn't one that just avoids problems. It's one that anticipates them and has a clear, actionable plan to fight back. And management here isn't sticking their heads in the sand. In fact, they have laid out a very specific blueprint to defend their fortress. So let's examine their battle plan.
Okay, it all starts at the highest level with 3 crystal clear priorities. Number 1, return to growth. They are not satisfied with just holding the line. They are on the offensive, looking to take even more market share. Number 2, elevate world-class customer service. In a crowded, competitive market, service is a key differentiator. It's what builds that moat around your business and justifies your premium pricing. And number 3, drive earnings.
This is a direct answer to all those margin concerns we just heard. They are laser-focused on protecting and even expanding profitability. This isn't some vague, fluffy mission statement. It is a disciplined framework for every single decision they're going to make this year.
Now, let's drill down on what is arguably the biggest external threat they face: tariffs. They are not just sitting back and absorbing this cost. They have a detailed 6-point plan to combat it. And honestly, this is a masterclass in modern supply chain management. They're going back to their vendors and negotiating for better costs. They're actively moving production to different countries to get around the tariffs. They're finding new efficiencies in their logistics network. And at the same time, they're using data to strategically adjust prices where the market will bear it, curating their product mix, and, this is crucial, recommitting to that core principle of driving full-price sales. This is a multi-front war on margin compression. It is a proactive, sophisticated strategy designed to insulate the bottom line from geopolitical shocks.
And to counter that weak housing market, they are actively forging new pillars for growth. This is all about smart diversification. They're pushing hard into non-furniture categories, things like textiles and housewares, which are far less tied to whether someone is buying a new home. They're leveraging these really cool, high-profile partnerships with names like Stanley Tucci to create buzz and attract new customers. Their B2B business is like this quiet giant, selling commercial-grade products to hotels, restaurants, and offices. They're also incubating smaller, high-growth brands like Rejuvenation. And they're not just talking about AI like everyone else, they are actively investing in it to make their entire operation faster, smarter, and cheaper. This is not a company that's sitting back on its laurels totally reliant on one single market. It's actively building new engines for future growth.
Okay, you know what? That is a very comprehensive plan. I will give them that. Obtaining cost concessions, resourcing production, B2B growth. It all sounds great on a PowerPoint slide, doesn't it? But a plan is just a theory. The real test isn't what they say they're going to do, it's what their own numbers project for the future. The ultimate proof of their confidence, or lack thereof, is baked into the official guidance they give to Wall Street for the year ahead. So enough with the talk, let's look at the forecast.
And here it is, the guidance itself. Let's break this down. They're projecting net revenue growth somewhere between, let's call it 3 and 7%, with comps growing between 2 and 6%. That is solid growth, especially coming on top of a record year. But the number you really need to focus on is the operating margin, 17.5% to 18.1%. Now yes, this is slightly below their record 2025 performance, but this is their projection for the coming year, 2026. Let's just put that into perspective. An 18% operating margin in the world of retail is absolutely elite. It is top tier. They are guiding to a level of profitability that most of their competitors can only dream of achieving. This forecast is a statement. It says their defense plan is largely going to work.
Right, but there is a critical piece of fine print in that guidance that you cannot ignore. They explicitly state that the pain from tariffs will be front-loaded in the first half. This is a crucial tell. They are essentially warning investors, hey, get ready, the next 2 quarters are going to be tough as those higher costs flow through our inventory. So their guidance for the full year is banking on a much stronger second half to make up for it. This sets up a major test. The next 6 months are going to show us if that 6-point mitigation plan is actually effective in the real world, or if it's just wishful thinking. The first half of this year will be the proving ground for this entire investment thesis.
Absolutely. And that sets the stage perfectly for our conclusion. We have examined the bull case, the undeniable strength of a fortress built on record profits and fantastic shareholder returns. We've pressure tested the foundation, identifying those potential cracks highlighted by the bears, the revenue miss, the margin pressure, and that inventory build. And we've analyzed management's detailed blueprint for defense. So now it is time to put it all together. It's time for the iron verdict.
So here's the final blueprint, laid out clear as day, side by side. On the left, you have the opportunity. This is the bull case. It's built on a rock-solid foundation of record-setting profitability, a clear and demonstrated commitment to shareholder returns through that big dividend, and proven market share gains you can see in their comp growth. And they have a clear, multi-point strategy to navigate the coming storm.
And on the right, you have the trap, the bear case. It starts with the simple fact that despite all their internal success, they fail to meet the market's revenue expectations. Their core profitability is contracting, which you can see in that margin squeeze. Their inventory levels are swelling, which could signal a wave of future discounting. And all of this is happening while the company faces significant macroeconomic pressures that are completely and totally outside of its control.
And so that brings us to the final critical question that you, the investor, have to answer before putting your capital on the line. Has this company truly engineered a fortress with a deep, durable competitive moat, one that's built from undeniable brand strength, supply chain mastery, and smart strategic diversification? Or is its impressive operational strength just a temporary shield? A well-built structure, yes, but one that's ultimately exposed and vulnerable to an inevitable market storm that could erode its foundations over time. The evidence is on the table. The decision of whether this is a risk worth taking is now up to you. For Iron Financial, I'm the market skeptic. And I'm the lead analyst. Go forge your portfolio.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.